Welcome back to the final video in the course. In this video, we are going to be going over oscillators. We're going to be explaining them. We're going to be talking about moving averages, your RSI, your MACD, and we're going to be going over bullish and bearish signals that these oscillators can display. So to get right into it, what are moving averages? Moving averages are basically simplified lines that display the direction of an asset. They come in different time frames. You can have like a 50 and 200 day pair. You can have a 12 and 26 day pair, or you could just choose one line. If you look in your top right, you just have your 50-day moving average. And if you look in the bottom chart, you have your 250 day. As you can see, as we talked about in the last video, you actually had a death cross over here, where your short-term moving average fell under your long-term moving average. And then as you saw after that occurred, the price went down significantly, and then you had a golden cross over here, which is basically the opposite happened, and the price went up significantly. Basically, it is dumbing down the price of an asset to show you how it is creating momentum. It's common to see prices either test, break, or bounce off of moving average lines. Moving on, what are oscillators? Oscillators are more in-depth signals available to traders apart from the charts that can help you verify your view of an asset, change your view of an asset, or give you an edge when a chart is neutral. Let's talk about your RSI, or your relative strength index. It measures if an asset is overbought or oversold. If you're above 70%, that means you're overbought, and if you are oversold, you have to be under 30%. Now you have your MACD, your moving average, convergence, and divergence momentum visualizer that pretty much displays how your moving average is moving. Weird terms, but you get it. It allows you to see where the momentum is heading based on the 12 and 26 day exponential moving averages. The lines show moving averages, while the histogram displays the difference between the lines, or your moving averages. To look at your RSI, here we have, if you can see, this purple range is kind of neutral. However, if you were, from let's say 50 to 70, you're a little bit hot, and then let's say if you're from 50 down to 30, you're a little bit cold. But basically what you need to be noting is if you are above 70, you are overbought, which means it's good to predict that the price can go down in the short term. And if you are under 30, it means you're oversold, and that means you can predict the price to go back up in the short term. Basically, it's just displaying, if an asset is, either too hyped up at the moment or too undervalued based on how much relative strength it has. And basically, if you ever see it overbought, just be careful if you own it, or if you want to short it, that could be another sign. And then if it's oversold and you don't own it, that could be another reason to buy it. Or if you already do own it, it could be a reason to keep holding and wait for the RSI to come back into the neutral zone. Moving on to your MACD, as you can see, it comes with this histogram and these lines. These lines are basically your 12 and 26 day moving averages. For the most part, I really don't even use these lines. They just don't really work all the time. They move up and down quite frequently, and they give you a lot of readings, which some may be true, some may be wrong, but just doesn't give you enough probability. What I really do use MACD for is this histogram, which basically gives you the difference between the two lines, and it shows you positive momentum in the green and negative momentum in the red. Now let's talk about the different signals that these oscillators can give you. It's kind of blurry because this is an older chart, but basically this is called bullish divergence, where you have lower prices, but at the same time that you're making those lower prices from here to here, you have a higher low on your oscillator. Here, this oscillator is your MACD, as you can see with the histogram. And basically, while that price is going down, your momentum is waning or going back up towards the green, which gives you regular bullish divergence. Now I'm just going to be looking at hidden bullish divergence. As you can see, you have your RSI here instead of your MACD. You can use your RSI or your MACD to find divergences, but the best way to do it is if both of your oscillators give you a divergence, it just verifies it more. But here's your hidden bullish divergence. Sorry, just a lot of different terms. Basically, you have a higher low on price, which means you run up and then you fall down, but where you fell down was higher than your previous low. And then you have the opposite on your oscillator, where you have a lower low. This is just your RSI, but basically, as you can see, you went down from this low to the next low. Now, a bear signal, known as regular bearish divergence, is if you have a higher high in price on your regular chart, but then on your oscillator, you have a lower high this can signal, as you see on the chart, after this occurs, it can signal, quite literally what the term is called, bearish divergence, some sort of appearance of bearishness coming in the future. Then you have your hidden bearish divergence, just another term. You basically have a lower high on price with a higher high on your oscillator. Again, you can use an RSI or MACD to try and notice these divergences. And if you can have both your RSI and MACD display it, that just helps you out a little bit more. But yeah, that's just your bearish or hidden bearish divergence. If you want to go back and take screenshots of these different divergences, I would recommend that, trying to study them so you don't have to, look at screenshots every time you want to look for them. But they are very significant, and they do display correct readings, I'd say about 75% of the time, when you want to predict what the price is going to do next. With all that being said, this wraps up our course on swing trading and technical analysis. I hope that throughout the videos you learned quite a bit, whether you were a beginner, an amateur, or a little bit more advanced. Just some final notes are to take profits, know when to cut your losses, understand probability, use your knowledge, never FOMO, be diversified, and find what type of trading works best for you before investing or trading with large amounts. And finally, good luck. If you want to keep up with what I'm doing, I'm actually going to be having a social media marketing course dropping in about a month. So if you want to be in the know for that, make sure to follow me on Twitter at Champion5 or simply subscribe to this channel. And thank you for watching everything, and I will see you later. Peace out.